Good morning, good afternoon, or good evening, depending on where you are in the world. My name is Kevin Spellman, and I'm your moderator for today's session. The first of at least 4 of our Defining Market webinar series this year. It's titled ESG and EVA, Making the World Better While Generating Solid Returns. I am the Senior Lecturer and David O. Nicholas, Director of Investment Management at UW-Milwaukee. I'm also a Senior Advisor to ISS EVA and a periodic adjunct professor to IE Business School. Before we get started with our speakers, let me take a few minutes just to thank some people and organizations and to introduce our speakers. So first of all, some thank yous. Our first thank you goes to our host, the Lubar School of Business Investment Management Certificate Program. The investment program is a premier program where students learn by doing over 2 years and enter the fields of investments, investment banking, and related areas. Our 2 presenting sponsors today are Johnson Financial Group and UWM Foundation. Let me tell you a little bit about each. Johnson Financial Group is a privately owned financial service company offering banking, wealth management, and insurance solutions through its subsidiaries, Johnson Bank, Johnson Wealth, and Johnson Insurance Services. They've been operating for over 50 years as a trusted advisor, engaged with family ownership and committed to their communities with strong values. Johnson Wealth provides wealth management services for individuals, families, retirement plan organizations and their employees, institutional advisory services for public and private foundations and endowments. They have over 140 people in 13 offices across Wisconsin and are responsible for over $13 billion in assets. Here's a quote from them. At Johnson Financial Group, we take a holistic approach to help you create a thriving, healthy future. An approach grounded on understanding that your financial goals are not separate from your personal ones. They're linked. As an independent family-owned business, we get it. So we listen, we learn, and we focus on putting your happiness at the heart of everything we do. Kind of like ESG, making the world better while doing good things for the world and having good returns. UWM Foundation is our other presenting sponsor. UWM Foundation supports educational, literacy, and scientific endeavors of the University of Wisconsin-Milwaukee. In addition to philanthropy and asset management, the UWM Foundation includes the UWM Research Foundation and the UWM Real Estate Foundation. They provide support for campus research, innovation, and research commercialization. In addition to these 2 presenting sponsors, Institutional Shareholder Services, Mergent, and River Water Partners are also sponsors. These sponsors have made this event possible and our future events, and their contributions create scholarships for my students. Thank you. I want to remind the audience that this is being recorded. You can have the video afterwards. We'll post it on our website. And also you can ask questions and answers with the Q&A feature of Zoom. We'll take questions at the end, maybe 10 minutes, maybe a little bit more. So our webinar, ESG and EVA, Making the World Better While Generating Solid Returns, earned its name. ESG has become very popular, and ESG is consistent with firms having good profitability. EVA, or economic value added, is just profits less the returns investors demand on that capital. It's viewed as being more representative than earnings in showing what the corporation is valued at. Both ESG and EVA positively related shareholder returns, as our speakers will show. I want to introduce our speakers. They include Anthony Campagna and Patricia Dorig. Anthony is the global head of fundamental research at ISS EVA. His team provides macro insights and screening for idea generation, sector and industry reports to provide context, company reports for single stock ideas, and portfolio analysis from the EVA lens. Prior to EVA, he was at Valens Securities. He also assisted in teaching at Hult International Business School and DePaul University. And before he was director at Valens Securities, he was an analyst at Credit Suisse in the Hult division. Patricia is joining us today from Germany. She's an ESG consultant at ISS ESG. She's an expert in physical climate risks and develops solutions for investors to evaluate the materiality of their physical risk exposure. She's also a project leader and a point of contact for the German-speaking market for second party opinion business of ISS ESG for green, social, and sustainability bonds. She's a public speaker and co-author of a study of climate risks. She holds a master's degree in Earth System Sciences from the University of Zurich in Switzerland. Anthony, take it away.
Great. Thanks, Kevin. So I wanted to start today's presentation with one line that I think will resonate well. More EVA is always better. And with that, I mean a firm that's generating more incremental EVA generates more profitability and therefore more shareholder value. But let me take a step back and just kind of talk about the origins of EVA. So I've got a picture up here. It's called The Quest for Value. And this is a book that was written by a gentleman named Bennett Stewart, who at the time was a partner at Stern Stewart Consulting. And they quite literally invented this measure. And as simply as we can put it, EVA is defined as sales, less operating costs, less capital costs. And by that, we're saying every dollar of EVA is fully loaded for all sources and uses of capital. So when thinking about in a management perspective, all of your business units or all of your plants or all of your products, boiling it down to total dollars of EVA is the one singular measure that matters most when trying to assess profitability through time. Now, that was a great business and they built it up and they still, it still exists today, but they focused on the management consulting side. And what we did is we approached Bennett and his partners and we said, we think there's an application to bring this to the front office. So we founded a company called EVA Dimensions. And with that, we brought EVA into the investment research process. And this was in 2012 and our coverage was small. And we built it up to about 17,500 companies in our coverage today. And back in 2017, we were acquired by ISS and are now a part of their global division of ESG. So what's most important is thinking about the way you can use EVA and EVA in an investment process. So for us, there's a couple of different ways that we work with our clients and we produce our research. The most important, and I'd say what our clients focus on most, is the idea around screening and idea generation. So right, our coverage universe today covers about 17,500 firms, and it allows our clients to look through cleaned up and adjusted accounting measures to get to this true version of economic reality. The three tenets of our framework are that one, more EVA is always better. Two is that we care about the economic profits of a business, not the accounting profits of a business. And three, that the value of any firm is measured as capital as we define it, plus the present value of future EVA. It's the same concept as a DCF, but it allows us to look at that stream of forecasted EVA discounted back to today. And when we apply that in that screening and idea generation process, it allows us to narrow down very wide investable universes into short kind of digestible pick lists that our clients can then synthesize and bring into their investment process. And that leads to single company work. So when you evaluate any one firm through the EVA lens, you're getting a consistent and comparable picture of its profitability today, as well as historically speaking, that you can take and put side by side with another firm, right? FedEx versus UPS. Operationally, they run the same company, but through their as reported financial statements, they're nearly incomparable. And I'll go through some of the adjustments that we're making to bring them in through the EVA lens to allow them to be compared side by side. And then what that lends itself to is portfolio construction. So when you think about managing a fund or putting together your portfolio, looking through the EVA lens and through the EVA framework allows you to objectively measure your overall levels of profitability, your overall levels of growth, your overall levels of risk, and the overall valuation picture of any one fund versus a benchmark or versus a peer group. So that gives us the ability to really work with our clients in an interactive way. And it lends itself to the ideas of using EVA as opposed to traditional accounting measures. When we built EVA and when we built the product to bring it to the front office, the idea was to bring a clean, consistent, and comparable measure of profitability. And that's something that really resonates with all of our clients. It's consistent and it's transparent. So we quite literally wrote a book on how to calculate EVA, and it's out there for publish. And we don't want to stand behind, kind of a calculation or a methodology. We refer to EVA as a glass box, not a black box. So we want our clients to understand what we're doing at any given time to get from, a GAAP number to an EVA number. And that allows us to continue to build and earn the trust of our clients so it becomes part of their ongoing investment process. And one of the key things that we think about when trying to measure the profitability of a firm is what adjustments need to be made. So when we take, an as-reported financial statement, a balance sheet, an income statement, or a statement of cash flows, we have to dissect it essentially line by line to get to this cleaned up and comparable economic view. So some of those key adjustments are really pertinent today, right? We capitalize intangibles. And if we think about the percentage of the balance sheet from 1999 to today, that's just transformed from what used to be categorized as intangibles to what is now categorized as intangibles, it's a shift from about 10% back in 99 to almost as much as 65% today. And that shift is just a really marked change in the way that GAAP-based, IFRS, and IAS-based accounting standards have allowed management teams to use the financial statements to essentially their benefit. And that to us and to the EVA framework is something that we need to adjust for. So in a quick summary, essentially what we do is we start with a traditional measure of EBIT. We make a series of adjustments. So we capitalize rent, we capitalize R&D, we capitalize ad and promotion. And a lot of what we're trying to do is remove the decision in financing that goes into the as reported financial statements to get to this economic reality, right? The matching principles of accounting would tell us that a calendar expense has to be tied to calendar revenue. But today's dollars of R&D aren't tied to today's revenue. It's tied to future revenue. So by capitalizing that, bringing it onto the EVA balance sheet, including it in our capital base, we treat it as an investment in the firm. The same can be said for ad and promotion, for leases, for rental expense. All of those adjustments that we're making, again, try to bring this consistent and comparable view of the economic profitability of a business through time. And it's not to say that every company requires every adjustment, but it's to say that our framework looks. So that example of FedEx versus UPS, one company owns their planes and trucks, the other leases their planes and trucks. So the balance sheet and income statement through a GAAP financial statement are incomparable. But by capitalizing those rented and leased assets, we're able to then look at not only the P&L side by side, but also the capital base side by side. So again, EVA is sales less operating costs, less capital costs. So let's just build this consistent and comparable picture of those two businesses side by side. And what it also allows us to do is build a company-specific model that shows incremental profitability, incremental growth, and all of the drivers that sit underneath that. So this top left panel is what we refer to as the EVA fundamentals. And through time, when we measure total profitability, we call it EVA margin, and it measures total dollars of EVA divided by sales. So all things equal, we want to see EVA margin above zero and rising. Essentially what that tells us is that the firm is earning above its cost of capital through time and widening that spread. Now the second measure, which is the blue dotted line in this top left-hand chart, we call it EVA momentum. And if that first point that I started with is true, more EVA is always better. This is our growth rate. This is our incremental measure of new dollars of EVA that the firm is generating. So again, all things equal, that blue line above zero and rising through time is one of the most important indicators we have within the EVA framework. And as you can see on that left-hand panel, the shaded blue area in the top of that chart is relative share price performance. And in this case, the market has rewarded this company, which in all but one or two periods in the last 20 years has delivered new incremental dollars of EVA and has continued to increase its overall level of profitability. It's rewarded shareholders massively with outperformance. Now, the next natural question that we get is, okay, well, what are the drivers of those EVA fundamentals? So in a stroke of what I'd call marketing genius, we built a chart and we built these measures that we call the EVA drivers. And again, it's threefold. And this is our version of the DuPont formula, where we're measuring sales, margins, and turns through time. The gray shaded area is just top line sales growth year over year. And then that blue dotted line is what we call EBITDA margin. And I kind of stress that last R because that's where we're making some of those accounting adjustments, right? We're capitalizing rent, capitalizing ad and promotion, capitalizing leases, making adjustments for LIFO to FIFO inventory accounting, pensions, OPEB, goodwill, one-time items, minority interest, stock option expense, off-balance sheet assets. Again, the list of adjustments is meant to be exhaustive, but it's not to say that every company has every adjustment. It's just to say that we're looking. And then the final measure, and what is I'd say was what partially most key within the EVA calculation is what we call capital intensity. It measures total dollars of capital divided by sales through time. And that's our incremental measure of the efficiency that a business has with the capital it's deployed. Right? Lower is more favorable, more dollars of sales per dollar of capital through time. So the three levers that management teams can pull are essentially increasing their P&L, EBITDA margin expanding, becoming more efficient with their assets, capital intensity falling, and then all things equal, or some combination of the three, a positive incremental sales growth through time. It allows us to build this simplistic view of the economic profitability of a firm so that it can be digested at any given company, again, across our entire investable universe. Now, how can we think about that in a macro sense? Right? There's a lot of inputs that go into the EVA calculation, one of the most important being cost of capital. And in today's environment where we're seeing basically historically low and persistently low cost of capital levels as communicated by federal banks, central banks around the world, we have to understand that impact in the overall level of profitability. In a really simplistic view, when cost of capital goes down, EVA goes up, right? Because we're charging management for sources and uses of capital. When we multiply capital by a lower hurdle rate, all things equal, EVA will increase. And very simply, again, thinking about how that would impact the overall value of a firm, lower cost of capital, all things equal, higher EVA will also increase the value of a firm. So while we're seeing global markets, and I know we're seeing a lot of red again today, but broadly speaking, global markets near or at all-time highs, the inputs to those equations become more and more pertinent at any given time. And that's something that we focus on consistently. And it also allows us to focus on the factor performance for individual firms, as well as broad-based markets. So this is two charts for the US, both large cap and small cap universe. And we try to think about what are the inputs and what are the drivers of these charts. And they go back to September of 2018, so about 2+ years at this point. And broadly speaking, in the US large cap universe, the left-hand panel, we're seeing a quality-driven market. And that was essentially year to date shown quite heavily during the March corrections and has held after a slight rally in the value factors post the March lows. But inversely, in the US small cap space, we've seen value take hold. So that lighter blue line in its relative performance year to date is outpacing quality, and that's a trend that's reversed itself. So when we're taking in all of those inputs and again, making the adjustments, trying to understand what the drivers of that profitability is, what the driver of that quality is, and what the driver of that valuation is, the EVA framework and the EVA lens gives us the ability to think through each one of those components and apply them in that individual company, portfolio level, or macro level view of the world. And where all of that analysis starts to come together is when we bring it into the sense of bringing ESG in to an EVA or a fundamental view. And I'll hand it over to my colleague, Patricia, to continue on with those thoughts.
Thank you very much, Anthony. Has been very interesting and impressive. I believe we are on the edge of a fundamental reshaping of finance. The evidence on climate risk is compelling investors to reassess core assumptions about modern finance. These are not my words, but the words of the CEO of BlackRock, the world's largest asset manager, and go to the importance of ESG. So this is also why today we want to talk about EVA and ESG. And the first point we will talk about is the importance of ESG and why it gained so much in the last couple of years. And then we will take a quick look and a deep dive basically into physical risks as an example of financial materiality of ESG. And in the end, we'll go over to the exciting opportunities that we have combining ESG with EVA. And on this first slide, let's take a step back and focus on the evolution of the perspectives on ESG. And also let's focus on this vertical axis where you see impact versus risk and opportunities. And what that shows is basically that the ESG investments that market started with the thinking of impact. So with investors that wanted to do something good for the world, like for example, churches and so on. But the main market, it really picked up from the perspective of the risks and of course, also opportunities. but mainly let's focus on the risk and see why that is. On the next slide, you see on the left-hand side a survey that was done from the World Economic Forum and the Global Risk Report in 2020. Just a quick reminder, that was before the pandemic in January. But kind of the main picture that you see, and what's really important, is that on the top right corner, you see these green points and these green circles. And what that represents is all environmental risks. So as you see on this graph, these environmental risks are the most likely risks, but also the risks which have the highest impact. If you're wondering now what kind of infectious diseases are located in this survey, you can see this gray dot on the left-hand side. So you see less likely, but also slightly less impactful. And just as a quick reminder, I mean, the pandemic hopefully will pass at some point, but climate change is here to stay. So since climate change is such a looming threat, it is a key driver of the ESG movement in general, and also this risk perspective from investors. So again, Larry Fink, the CEO of BlackRock, says climate risk is actually investment risk as well. And kind of this acknowledgement on the next slide, this acknowledgement that ESG and climate change brings so much risks and therefore is a threat to financial stability, brings with it a lot of reporting requirements, but also action initiatives. So not only governments who want to regulate the risk, but also really industry stakeholders that show up and want a change and to tackle those risks. And you can see here, it's quite an extensive list, but it's still not extensive at all because there's so many out there. But quickly just want to talk about this Task Force on Climate-Related Financial Disclosure, TCFD, which was created in 2015 from the Financial Stability Board. And what it does is basically it creates a consistent framework to disclose the climate-related risks that a company faces, banks face, but also investors face. And why do I bring that up? It's also because ESG becomes such an important topic that even if you maybe don't care that much about it, regulation increases and you're required to have a look at it. Because, for example, again, BlackRock, world's largest asset managers, in his annual letter to the CEOs, said that he expects all companies to disclose on the TCFD framework this year already. And if they don't do so, he will assume the worst, namely that these risks are not adequately managed. So in turn, what this means is that this leaves BlackRock thinking that this is a riskier investment, right? Because they acknowledge that climate change and sustainability are material risks. So companies that are lagging behind taking action on this and also disclosing their risks will see their costs increase and be penalized by investors. So again, why did ESG, one slide, it's still the same slide, thank you. So again, why did ESG grow with such importance? And the question is actually pretty simple, and it's because companies as well as the financial systems, they do not operate in a vacuum. They are very much impacted by the environment they're operating in, as we've seen also with the pandemic. So basically, there's a wide acknowledgement that ESG is very much interlinked and also the basis for financial success in the future. And that is why ESG grew in such importance and is also here to stay. Now that we've looked at that, we can take our deep dive into the climate risks on the next slide. Thank you. Where we mainly focus on physical risks, but I nevertheless wanted to quickly list the main key climate risks that can be in two buckets, basically. We have one bucket with the physical risks, and they deal with the impacts that the changing environment has on companies, whereas the transition risks deals with the risks of the impact a company has on the environment. And one example from transition risks would be carbon prices. So if you are invested in a company that's very emission intense compared to, for example, its peers, and the carbon price scheme will be implemented, then obviously you have much higher costs than your peers have. And this in itself is again a material risk. But for this purpose, let's focus on the physical risk side and take a deep dive. And on the next slide, you can see that physical risks clearly have financial impacts. So on the left side, you see an example of Sony. And Sony blames the Thai floods that happened in 2011 for the doubling of their losses this year. So clearly a big impact that is already happening. So it's not just in the future. But if we look into the future on the right side, you can see how projected floods increases. So basically the intensity is expected to increase, but also the frequency. So we will have to deal with such events as Sony had to deal with in 2011 much more frequently. And again, also then the financial impacts this has. So as a first step to look at physical risks, you need to look at the geographical distribution. And also in the slide on the right-hand side, you see that it's really heterogeneously distributed, this risk. So our assessment first starts with modeling actually the future climate change. And on the next slide, you then see the next step. And that is actually looking at company specific and their actions. So where are they active? And also where is the value distributed? One example, Sony Thailand floods, right? If, for example, are you invested in a company that has all its production sites in Thailand, where floods are expected to be more frequent and more intense, and therefore all the time have an impact on the financial statement? So these are the types of assessments that we do. Then we can, if we know the future state, we can calculate damages to facilities, but also business interruption costs. And in our assessment, we hit all those factors in the EVA financial statement as well, to come in the end to a re-evaluation of the company based on how the environment will change in the future. And this is for company specific, but on the next slide, you can also see that can be aggregated on a portfolio level. So what you see here is basically the portfolio value change that is expected due to only physical risks, only looking at physical risks. And you see, therefore, it has absolutely financial materiality. Then on the right-hand side, it comes back a little bit to the TCFD discussion we had before, that investors want to know more and more how companies deal with those risks. So they acknowledge that the risks are material, that they are impacting the financial stability of the companies they're invested in, but they also want to know now how companies deal with that and manage these risks and reduce, hopefully, those risks. So during that talk, we've seen why ESG is so important. And now we've done this deep dive on physical risk. But it's also very important to look at ESG in a whole, so a holistic performance metric, basically, because on the lower side, we can see various indicators, for example, that go into ESG. So physical risk and climate are the E, right? The environment. But then there's also social component and the governance component. And usually there are really many such indicators that flow into this ESG performance as a whole, and they can also be sector specific. But these ESG ratings allow us to get an overview of the performance. So we've talked about the importance of ESG and why it grew, and basically because of its financial materiality. We've done this deep dive and now opened up on the ESG performance in total. a holistic perspective. And I now want to hand over to Anthony about all those exciting opportunities that we have in combining ESG and EVA.
Great, thanks, Patricia. So when we bring these two proprietary data sets together, right, EVA on the financial side and ESG kind of covering the environment, social, and governance side, we conducted a study that looks to essentially evaluate the materiality of those ESG ratings and the impact they have on relative returns. The results were great, and this isn't to kind of pound our chests. We back tested this a few different ways. We shared it with other academic institutions. We shared it with clients to have them validate our findings. And we came up with 4 major findings out of this study. The first is high ESG performance. So firms that have good levels of governance, strong levels of environmental impact. So the right kind of triggers in place to lower their carbon footprint, the ability to work with their employees. So levels of engagement, levels of employee satisfaction, and their social scores. So thinking about paying minimum wage, avoiding child labor, all of these practices and things that we're measuring inside the ESG assessment gives them this high ESG performance score. And when we marry that with high levels of EVA margin, so high profitability in terms of adjusting for the economic reality of those businesses, we find relative outperformance to the peer group. We also find that the high levels of ESG ratings are positively related to valuation, meaning good ESG means good and healthy valuation. And while that might scare you as a portfolio manager to say, well, I don't want to buy expensive companies, it also is a way to think about firms that are investing in their ESG scores and their practices tend to be recognized by the market with higher valuation premiums. And as a current shareholder, that's a wonderful thing to see, because you have the ability to engage with management, whether it be through stewardship and voting and proxy, to help them improve those practices through time. And the inverse of that also holds true, that firms that have lower levels of ESG scores tend to have lower multiples in the market. And an additional finding was that profitability is negative, that the ESG profitability or ESG performance and EVA profitability is negatively correlated with volatility. So you're getting lower levels of risk, essentially a free lunch, with higher levels of profitability and higher levels of ESG. We also find that high ESG companies, and this goes back to the way that EVA is evaluating every dollar of capital, so all sources and uses of capital that you, the investors, are providing to management teams, high ESG companies are good allocators of capital. And that goes back to good governance, right? They have the right levers and triggers in place to make sure that there's capital control, that they're not just going out and spending on growth too much, right? The board has oversight on key committee decisions, and all of those go into that ESG score to say, right, ESG companies are good allocators of capital. And the last point, and this is quite interesting, that ESG firms tend to be less cyclical. So just in terms of kind of the ebbs and flows of business cycles, lower cyclical companies, right, tend to be technology, healthcare, consumer non-durables. And those firms tend to score better in the ESG profile. So if you're thinking about where to allocate capital, starting in those areas is a great place to start. But it also allows you to think about the areas that don't tend to score well in ESG and finding the leaders in those spaces. And that's one of the things that the ESG research team within ISS focuses on quite acutely, right? Our scores are industry relative. So you can think about, right, broadly speaking, energy, not generally accepted to be a very good ESG space, but you can find firms that have good tendencies, that have strong pillars on either the E, S, or G side, so you can increase your overall portfolio exposure to those names. So it's a good way to think about kind of framing that discussion. And the chart on the right is just to exemplify the way that we broke down the results of this study. The 1-1s are essentially a binary distribution of high ESG, high EVA margin versus the 2-2s, which are low ESG, low EVA margin. And as you can see, you almost double your money owning the 1-1s versus owning the 2-2s. So in a long short portfolio, that's a really good way to capture upside alpha and avoid downside risk. And those are essentially the exact results we wanted to see. And then when we break it down further, we look at a quintiled study, so 1 through 5. So top 20th percentile would be 1s, bottom 20th percentile would be 5s across both ESG and EVA margin. We find those results to be monotonic, meaning those 1s in the top left-hand corner outperform 2s, 3s, 4s, and 5s. And that, again, to us, just really solidifies the findings of this study. The second component of this data table here, the standard deviation, is showing, again, lower levels of volatility associated with the higher levels of ESG scores and higher levels of EVA profitability. So again, reducing portfolio risk, reducing the risk you're taking on and owning these companies through time while generating higher relative returns is essentially that free lunch. So it's a really powerful way to bring these two pieces of information together. And, when we just look overall at the kind of assets being allocated in the ESG space, right? Over $20 billion has grown just in ETFs alone this year that are focused on ESG investing. Over the last 3 years, that growth rate has nearly doubled every single year. And we only see that momentum growing in the space. So as ESG becomes part of the investment decision process and moves into the front office, it's really key to think about that financial materiality component, because it allows you, the investor, to take control of that piece of your investment process and find alpha and sustainable alpha in doing so. Kevin, I realize we're a bit early on time, but we'd be happy to take a couple of questions from the audience if anybody has any.
Oh, we're perfect. I have a bunch of questions, and we have one from the audience. I'll let you look at that question, maybe prepare an answer, but let me start out with some questions here for both of you. Why don't I start out with Patricia? How have good ESG companies done during this coronavirus crisis?
Yeah, that's actually a very interesting question. And maybe Anthony, if you could share again the slides deck, because we have that in the appendix. Yes, perfect. Thank you very much. Because it's actually really a question that we get quite a lot, and it's very impressive results underlying, again, also the results we've seen before combining ESG and EVA. And there is really a very, very clear picture, and that is that ESG funds outperformed traditional peer funds. And you can look at different studies. So here are two examples, one of BlackRock, the other one of a study Morgan Stanley did. And so BlackRock found that 94% of sustainable indices outperformed their parent benchmarks in Q1 2020. And year to date, it's still 88%. So they've done really, really well. And on the right side, we see basically the same picture. And that is that sustainable equity funds outperformed their traditional peers by a median of 3.9% in the first 6 months. So it's really kind of ESG, as I like to look at it, is a win-win-win situation, basically. Because you get higher returns, you do get them, while at the same time you lower your volatility. And as a third win, as the cherry on top, you also have a good impact on the world, a sustainable impact.
Hey, Anthony, when I ask you a question here, when you give a story, let me even back up a little bit. You presented in the beginning that ISS purchases business from Bennett Stewart, who created this concept of EVA back in the 1980s, actually. His colleague, Joel Stern, was one of the first to formulate free cash flow, okay? So EVA and free cash flow came about at the same time. Can you kind of share the reason that maybe EVA could give additional insights over free cash flow, which people use to discount the great, determined value?
Yeah, great question. So when we think about EVA versus free cash flow, right, they're similar. They're not kind of sister calculations, because within EVA, we're talking about sources and uses of capital. And that's something that as a management team, you really need to be cognizant of. And as a investor, you want your management team to be cognizant of, right? You're the supplier of capital, and every dollar of capital that you give to management, you are essentially hoping that they deploy in an effective manner. So not that free cash flow is a bad thing. It has lots of value, and it's good to have companies that have free cash flow through time, and we can use the DCF to try to value those companies. But if we can get the additional insight on their ability to deploy capital effectively, which is what EVA gives us, then I think we're getting a boost to the overall information that can be discerned from that metric and measure. And what's really interesting is we've actually written some white papers about this. You can tie an identical calculation between EVA discounted back to the net present value of a firm and free cash flow discounted back to the net present value of a firm. You'll end up with the same answer. But using the EVA framework, you just get an entirely different level of detail into the decisions that management has made through time and what they might have to do going forward to sustain that level of profitability. And again, just not that we can forecast the future, but having a better kind of finger on the pulse on the decisions that management teams can make allows you to use EVA in a much more effective manner.
Okay, so I'm going to do one more question, and then why don't we take some questions from the audience that I see they're chatting in. So Patricia and Anthony, maybe take a look at those, and you can maybe take any of the three. But Anthony, why don't you talk about how EVA has transformed a company that's adopted it through their actions?
Yeah, I mean, one of the case studies that we point to a lot is Coca-Cola. They were one of the early adopters of EVA. Roberto Goizueta is the first billionaire made by executive compensation. And the process that they put in place was essentially to streamline their capital allocation. Right? They're famous for saying they didn't want Coke or an option to buy or purchase a Coca-Cola product to be more than a mile away from every person in the world. But when we think about what they did operationally, it was right-size their capital base to make sure that they were efficiently using all sources of capital that they had through that franchising model, through the bottling model, and through time, their ability to expand their profitability, essentially that cleaned up EBITDA margin, what helped drove the profitability of the firm for so long. It's a wonderful study to just understand how simple decisions in the operating side of the business can really increase profitability. And when you think about it, it all boils down to that capital allocation story. And again, the differences between free cash flow and EVA highlighted there in one of kind of I'd say the blue chips in the world in terms of overall performance.
Okay, great. I'm going to take Joe Frona's question in the Q&A. Patricia, maybe you can take Iran's, and Anthony, maybe you can take the first one from Kent. I'll go with Joe's. Joe's question is basically asking about the study that was shown from 2013 to 2020. I was actually the author of that study, so I can comment on that a little bit more. So Joe is basically saying that ESG funds have pretty much been overweight the FANG stocks. We told you earlier that high ESG companies tend to be in technology, healthcare, consumer non-durables. That is true, that they may be overweight in some of these really good performers. However, the study was also done on a sector neutral basis, just to see if the sector was biasing the results. And generally, that's the key word, we found the same results doing the sorts within sectors as we did across the entire universe, which is a good thing. It basically means being good to the world is also consistent with being good to shareholders. Patricia, would you like to take this one on from Iran on standardization of ESG scores and maybe some obstacles to implementation because there's not as much standardization right now?
Yeah, thank you very much. And actually, that's a kind of a hot discussion in the market at the moment. And what this refers to is that if you look at a company, it can get different ESG scores based on different providers. And that is because because the different indicators that I've also shown right on my slide are weighted differently. So basically what that means is that ESG rating from different providers show how they see the world. So what they think, which indicator is most relevant and therefore higher weighted, right? So it's kind of, and there are these two parts of the market. The one side that asks for more standardization so that all ESG ratings basically weight their indicators in the same way. And the others as well say that there's a benefit in having different ratings and different world views. Because basically it's kind of, there's this analogy that goes around. It's a barista that makes you a cappuccino, and you can mix it and do the ingredients yourself. So you can also then, you have also the opportunity to then decide what world you think is right and what you prefer, and not kind of a standard that tells you what to think and what to do.
So you're saying some people may say it's an obstacle, ESG, that we don't have one standard. You're saying actually it's probably a good thing because there's many different ways to look at the subject. An example that I've heard of over time, and you don't have to comment on this, is some people think good E or S, the S part is investing in companies that make weapons, because that keeps the world safe. And other people may say, well, weapons kill people, so that's really bad. So, that's, again, having multiple standards may be a good thing because there are different points of view.
Exactly. And one quick addition is also that we provide the underlying data, right? So it's not a black box where it's not known how these are combined.
Okay, great. Yeah, Anthony, would you like to talk about the question from Kent on governance versus environmental versus social scores and the efficacy?
Yeah, so it's a great question. Obviously, what we displayed was the high level, what we call ESG corporate rating, and that brings together the E, S, and G pillars. And the question centered around did you find any efficacy around any of those being more important versus the other in the back test? The short answer is we found some, and the long answer is we're still looking. So what's really powerful about the E, S, and G pillars is, right, they're ever evolving. And what's more evolving is what companies are disclosing around those pillars. And part of the challenge, and this goes to the standardization question, is every company is different with what they're telling us around E, S, and G policies. So we have the ability, and what our research team does is to dig through those financial statements, understand what management has disclosed, and also derive some of the metrics that we need to get there. Now, standardizing that data across a large data set does present its challenges, so we're still working towards that. And part of the basically follow-up of this study is to look individually on the E, S, and G side, what's the most important, and by region, where we can try to highlight what might be more disclosed versus less disclosed and how that can be used in an investment process.
Okay, great. Patricia, I have another question for you. There's been a lot of movement in Europe on just encouraging investors to focus on ESG. Can you talk about the EU taxonomy? And that's something relatively new and is being implemented right now.
Yeah, no, absolutely. Thank you very much. That's very true. In the EU, there has been a lot of movement and a lot of regulations as well. And under that kind of action plan that the EU had is also this EU taxonomy. And what it does is it defines what green economic activities are and what thresholds they need to apply or comply with to be defined as green. And so they give this framework and this standardized framework, right, to define what's green and what's not green. And what they require investors to do is that they basically disclose how much of their portfolio is EU taxonomy compliant and therefore green. So which share of your portfolio is green. And that's obviously a big requirement, and also then pushing companies in disclosing how much of their revenue is also green, because that's then in the end how investors add up, right, how much of their investments is green. So this is really also pushing the market to more disclosure.
Okay. All right. I remember Bennett, when he talked about EVA, that how you evaluate management is how they will be incented to behave. So this is a question for Anthony. How is management currently normally evaluated in the proxy statements, and how would having a more of a focus on EVA change their behaviors?
Yeah, it's a great question. One of the things we often talk about, incentives dictate behavior. So what gets measured gets done. And it's hard to say that every company pays their management the same way. But broadly speaking, we do see some very consistent components of compensation packages, usually focused around top line growth. So sales growth, some sort of EPS growth, sometimes an EBIT or EBITDA margin. And it does lend itself to financial engineering, because most often, or what's lacking most, I'd say, is some capital control component, right? If you or I, Kevin, were paid on top line growth with no, unlimited access to capital, let's put it that way, we'd just go out and we'd buy. We'd go on a spending spree and we'd say, we can grow the top line hand over fist because we'll just go out and buy growth. But if we aren't monetizing that growth, right, if we're just overspending and the goodwill balance continues to grow and grow and grow, we're going to destroy value over time. So by including or thinking about using EVA in a compensation scheme, it brings both sides, not only the top line sales growth side, but it also brings the capital control side in to say, you don't have unlimited access to capital, right? You management, your job is to effectively deploy the capital that shareholders have provided to you. And by evaluating them through that lens of EVA or some cleaned up version of profitability, we'd say that's a really powerful way to align management with shareholders through time. And again, we've written a few studies around inclusion of EVA in performance and firms that have generated positive incremental EVA outperforming through time.
So that capital is something that's scarce, it's precious to shareholders, and EVA charges you for the capital, so you better have a return for it, where earnings ignores the capital charge. Maybe there's a little interest on the income statement, but with rates so low, it's kind of ignored.
Yeah.
So I'm going to go back to Patricia here and take some questions from the audience. And we have two that are along somewhat the same line. Is the push to ESG, is it coming from shareholders, or is it they have a good conscience? And then another question is, do you think the framework for investing will change as ESG becomes more important?
Yeah, maybe let's start with the second one. Yeah, I do think it will change, right? With my quote as well from Larry Fink, who's really said that kind of some of the basic concepts of modern finance will change. So I do feel that a lot will change, and that the ESG focus will only grow. And therefore, at some point, I mean, not today, not tomorrow, but will kind of merge, so that it's really kind of a standard to look at. And that's also where legislation moves towards, right? As well, we see that a lot. So this then refers a little bit more to the pressure, whether companies look into ESG out of their conscience or due to shareholder pressure. And I think it depends a lot. Obviously, we also see corporates that really kind of want to do good. But it's a lot of different perspectives. As said, kind of it's a wide acknowledged that these risks are really material. So I think it's not necessarily the good conscience that companies act upon, but really also because they see those risks are material to them and are material to the financial stability, and that they have to do something about that. And that's also where then regulation comes in. So I think it's a bit of a pressure from all sides, to be honest, that drives us in that direction.
I've even seen advertisements on TV from Amazon about changing the world by being climate health conscious. Also see the Prime trucks going down the road all the time, and I think they're electric vehicles. Can you talk about an investor that successfully implemented ESG into their practices?
Yeah, to be honest, we are not allowed to talk about clients, so that is it's a little bit of a tricky one. I think successful can be viewed as before, right, from many different perspectives, and I think that's already also the answer, to look at really ESG as a whole and not just kind of from one perspective. As I mentioned quickly before, right, you can quantify the risks as kind of from EVA, how much of your share price is actually at risk, but you can also complement that with a more qualitative view on kind of how risks are managed. But maybe just one more from the question before on also why kind of ESG will become a standard and more important. It's also actually because of the wealth change to millennials. Because we see a lot of studies that show that millennials really care also about the impact, right? And so more and more of these people start investing as well, which also drives kind of the impact fund discussion a lot. So I think really it's from various perspectives.
So I'm going to ask this one of both of you. We have a question about just if there's a commodity-driven bull market, how could you maybe invest? First of all, let's look at the both EVA and ESG perspectives for commodities. Is there a way to, invest in there from an ESG perspective, or what kind of companies would you typically look for? Anthony, you talked about some of the company's biggest mistakes are maybe overinvesting in capital. So do you want to start off here?
Yeah, I mean, one of the biggest challenges in energy today is the sunk capital that's in wells, in rigs, in pipelines, all of these things that exist that today are basically underwater in a profitability sense because the price of oil is so low. Investing in commodities is it's a dangerous game, and the way that we kind of think about it is there hedge cost or is it a mill on a hill? So at times you can get good operators that have hedged out essentially the value of their mine or the value of their well or the value of their reserves. So you're just getting in the operations of the business. But if there is truly risk around the price sensitivity for the commodities, that's something that is not my guess is as good as yours, but understanding what the long-term fundamental supply and demand profile of that commodity is. I think broadly speaking, we've seen since the shutdown in the pandemic, the lowest levels of coal consumption globally in the last 30 years. That's a trend that seems to have gotten a little bit of a kickstart because more and more of us are staying in our homes and not commuting and not consuming some of the end uses of fossil fuels as we were before. And then at the same time, right, technological innovation has priced solar at the lowest level it's ever been. So it's hyper competitive in terms of competing on the electrical grid side. So there's a lot of structural systemic changes to the commodities profile today versus yesterday and today versus tomorrow that I think are going to continue to pressure that capital allocation picture. So the long-term viability of some of the old line commodity-based businesses might get challenged in the future.
Okay. And I know with the ISS ratings on ESG, they're industry specific. So there's different things that may matter more on ES and G for different industries. If I remember right, Patricia, in the commodity space, there's different things you look at versus maybe some other space. Can you comment what industry specific things you look at in commodities?
Yeah, to be honest, I'm not the ESG rating specialist, so difficult to answer that. But yeah, no, definitely. So the ESG ratings, they have kind of these cross-sectoral indicators, but also sector-specific indicators where we would then really go deep into the analysis. Okay.
Well, and again, the person who asked that question was talking about like lumber and copper. So I'll just, Glenn, you could maybe email me afterwards and we'll get you in contact with the right person to answer these questions. But I know ISS has all kinds of different ratings for different industries. Is there anything else, just kind of in closing, I have some thank yous, some final comments that you would just like to leave the audience with before we close today?
Yeah, I mean, largely speaking, and this kind of echoes what Patricia said earlier, the shift from impact or ESG investing today versus what it might look like in 3 years, 5 years, 10 years, is it's just going to be investing. And ESG is slowly growing in the US, but broadly speaking, catching up from the rest of the world in terms of its place in the front office. So, with these studies, with the collaborative work that we're doing, we really think that we're putting our best foot forward in the way our clients can use both the EVA and ESG in their investment process.
All right. Well, thank you, Patricia. Anything? Oh. You're
Yeah,
fine?
I know, but just that ESG, that we really believe that it's the future and that all the standards will come and push into that direction. And it's really better to start early than late.
Okay, great. Well, thank you for the audience today for being here, and our sponsors, our presenting sponsors, Johnson Financial Group and UWM Foundation, our other sponsors, River Water Partners, Institutional Shareholder Services, and Mergent. I really appreciate you putting this together and making this possible today. And of course, our speakers, Anthony and Patricia, you've been great. We also have, I think, some website links if you want to get more information. You can reach out to ISS EVA at this link, ISS ESG. And of course, if you're hiring students or have any interest in helping out an investment program, the last link is the investment program. Thank you for your time today. We have a few more webinars coming up and later this year on alternative investments, and next year on investment strategy and state of the economy. Hopefully you can join us for those events as well. Have a great day.